You always hear us talking about dividend-paying whole life insurance designed for cash value accumulation. But what exactly is dividend-paying whole life insurance? Well, today we're going to do a deep dive on exactly that topic. Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
So let's just start with the basics. What is a whole life insurance contract, right? So a whole life insurance policy, the insurance company is making you two promises. The first is to pay that death benefit out anywhere along the way as long as the policy is in force. And the second is to have a cash value equal to the death benefit at the age of maturity, which is typically age 100 or 121.
So with that, you're getting perfect compounding, because in order for the insurance company to fulfill that second promise, to have cash equal to the initial face amount at the age of maturity, they have to put more money aside this year than they did last year, and more money still next year than they did this year. And consequently, you get something like this, which is the equivalent of a compound interest curve, starting at zero and then working up to the initial face amount. So you're getting interest already. But dividend-paying whole life insurance adds a second layer of earnings, which is the profits of the insurance company. You see, when you buy a policy with a mutual insurance company, you get to participate. Another word for dividend-paying life insurance is called participating life insurance in the company's profits, what's known as their divisible surplus. And consequently, you get these dividends paid out every year on the anniversary date if a profit is made.
Right. So with a participating whole life insurance policy, basically the insurance company charged you too much for your premium, and so they give that excess premium back to you, right? And it's really interesting with the whole life policy because those are tax favored dividends. It's not something that's going to go on your tax return every year. It's just a return of the premium technically.
And it's key to note that the reason dividends in life insurance are not fully taxable and, again, tax favored is due to the lobbying efforts of the insurance industry way back in the 1900s. When the tax code was initiated, the life insurance lobbying group lobbied Congress to have dividends tax favored. And literally, a dividend is categorized as a return of overpaid premium, and consequently, you get this tax-favored status.
Right. That's why it's so important to pay your premiums with after-tax dollars to maintain that tax-favored status within the policy. As long as the money stays within the contract, or even if you're paid the dividends in cash, that money is able to grow on a tax-favored basis.
Absolutely. So that's literally the basis of what dividend-paying whole life insurance is all about. So now we should start looking at ways where we could increase those dividends. Mm-hmm. And there's actually two ways that that could happen. One is within the control of the policyholder, and the second way is in the control of the insurance company. So the way that a policyholder can control the amount of dividends or make the dividends go up each year is, number one, buy or purchase paid up additions, which is that paid up additions rider that you may have heard from other folks on social media. And so when you put more paid up additions into the policy, you're actually purchasing paid up life insurance. And if you're doing it with a mutual insurance company, they're going to have profits, and those profits, hopefully, will generate dividends that are passed on to the policyholder. Because when you're a policyholder with a mutual insurance company, we've said this before, and we're going to continue to say it, you are literally the owner of the company as it relates to your policy. And therefore, any profits that the insurance company makes on your policy come back in the form of tax-favored dividends.
And the companies that we deal with have literally been paying out dividends year over year consecutively for over 120 consecutive years. So through depressions and recessions and world wars and
gas crises and
all of the above. I mean, think of all the things that have happened in the last 120 years, pretty much everything under the sun.
Tariffs. I mean, come on.
So basically, we're using these reputable companies who have a long-standing history of paying dividends to their policyholders. And with that, we're able to earn a profit for our clients, and they're able to use that money all along the way, not just waiting until the death benefit is paid out to their beneficiaries.
Exactly. Now, the second way that dividends can increase, or those dividends can go up, is through the profitability of the insurance company. And that's where it's really important to choose an insurance company that, as you noted, has a track record of 120 years of paying dividends. But more importantly, you want them to be very selective in who they're insuring. You don't want them to be willy-nilly and insuring people who may not be a good risk, so to speak. So because of that, they put you through some sort of a rigorous qualification process. You have to fill out an application. You have to answer medical questions. You might have to take an insurance physical. All of this is really leading to profitability. The insurance company understands this. That's their business. So the more diligent they are up front, the better the profits will be, and ultimately the dividends, as all things being equal, as time goes by.
So next, let's talk about what could lower your dividend as a policy owner. What could penalize you? And with some companies, not all of them, the company could lower your dividends if you have an outstanding policy loan.
Yeah, it's a concept called direct recognition. I think in the end, it may not mean a whole heck of a lot, but the reality is this. If you're purchasing the insurance for the express purpose of borrowing against the cash value somewhere down the line, why should you be penalized for doing what you want to do? And to me, that doesn't make sense. So we try to do business with companies who don't penalize you or reduce your dividend when you have an outstanding loan.
So that would be considered non-direct recognition, meaning the net cash value is not recognized when calculating the dividend. The policy is going to perform how the policy is going to perform, whether or not there is an outstanding loan. Versus direct recognition, the insurance company is going to look at that net cash value within the policy, meaning the cash value minus that collateralized loan, and credit your dividends based on that amount. So if you didn't have a loan, you could potentially be earning a higher dividend in that case.
Yeah, and so the argument you hear from the direct recognition agents is, well, if I don't have a loan and you do have a loan and we get the same dividend, that's not fair to me. Well, hold on, because here's the issue. Direct recognition is analogous to this situation. Let's say you have a CD at a bank and you're earning 4% on the CD. And let's say it's a 4-year CD. And 2 years into the CD, you decide that you need a new car. So you go to the bank, because that's where your banking relationship is, and you ask for a car loan, and you get the car loan. And about a month after you get the car loan, you notice that your CD was credited less interest than 4%. And you call the banker and you say, hey, why did you lower my CD interest rate? And they say, oh, that's because you also have a car loan. Well, tell me that makes sense.
Right, because in either situation, whether you have direct recognition or non-direct recognition, the insurance company is charging and earning interest on that loan, right? So there's not really a reason in that case to level the playing field by changing the dividends that are credited.
Yeah, so it just, to me, Direct recognition seems like a money grab for the insurance company. And that's okay. Because again, if you're dealing with a mutual, that money's coming back to you ultimately somewhere down the line. But it just doesn't make sense on the surface. And because of that, we just try to avoid it whenever we can.
Right. So there are some companies that are direct recognition, some that are not. The policy owner doesn't have much control over that after the policy is placed. It's something that you look into before you place the policy.
That's a great point.
In conclusion, dividend-paying whole life insurance policies are issued with mutually owned life insurance companies and their whole life contracts. If you'd like to learn more about putting a specially designed whole life insurance contract to work for your family, your business, and your situation, be sure to visit our website at tier1capital.com. Also, if you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.